UK pension transfers. PTS are professional, experienced team, all UK migrants who have worked in the UK pension industry. We pride ourselves on being experts in navigating the UK and South African pension landscape, dealing with all manners of pension schemes. What is a UK pension transfer? It's a transfer of benefits of a UK pension scheme fund to a recognised overseas pension scheme, formerly known as CUROPS. ROPS schemes must have been registered with the HM Revenue and Customs, and any transactions made within the ROPS must comply with the UK pension legislation and are reportable back to the HMRC for a minimum of 10 years. A UK pension transfer to an overseas pension scheme must be a recognised transfer under the UK Finance Act 2004. If a transfer is made to a non-ROP scheme, it is classed as an unrecognised transfer and therefore treated as an unauthorised payment. An unauthorised payment charge of up to 55% would be payable from the member's fund if transferred to a non-ROP scheme. There are a lot of common mistakes that can be made on a UK pension transfer. The overseas fund must have ROP status before any transfer can take place. The transfer funds are reported for a minimum of 10 years from the date of transfer. If a transfer occurs to a ROPS self-managed super fund, then there are certain investments which cannot be held, i.e. purchasing residential property, commercial property is permitted, or borrowing more than 50% of the net asset value of the fund. ROPS must essentially mirror UK pension scheme rules, i.e. 70% must be retained for an income for life. ROPS must be registered with HM Revenue and Customs. It's recognised for tax purposes in the country of origin, and it must undertake to notify HMRC if it ceases to become compliant. It must adhere to the required reporting requirements for a period of 10 years from the date of transfer. HMRC must be notified of any withdrawals, rollovers or pension commencement. There are various types of UK pensions: defined benefit final salary schemes, BP, company pension or local government schemes, defined contribution money purchase schemes, personal pension, stakeholder, AVC, Section 32 buyout, couple of examples: Standard Life, Legal and General, hybrid schemes, and UK state pension, which is linked to national insurance contributions made. The pension income is guaranteed and inflation-proof for a defined benefit scheme, and it's payable dependent on the number of active years within the scheme and the salary at date of leaving. All the investment, mortality and inflation risks are actually borne by the scheme. The majority of these defined benefit schemes are now actually closed in the private sector, so national health, police pension schemes, they are no longer permitted to transfer, and nearly all of the public sector schemes are underfunded. Contributions are defined and the benefits at retirement depend on many factors. The value of the fund will fluctuate over the period of the investment term. Some of the administration charges can actually erode the fund over time. The actual pension payable is dependent on investment performance, interest rates and inflation. Hybrid scheme is a defined benefit scheme, and it includes characteristics of both the defined benefit pension and the defined contribution. It has guaranteed benefits which are capped and topped up by the defined contribution investment pot. There are certain funds that can be transferred and certain funds that can't. Any defined benefit final salary scheme, except any underfunded public sector funds, National Health Service, police pension and some local government schemes can no longer be transferred. Any defined contribution scheme, any hybrid scheme, the UK state pension and the additional state pension cannot be transferred. The payments received from this will be dependent on the number of national insurance contributions made. There is now a new requirement for UK advice for any defined benefit schemes that are over the value of £30,000. A UK report and advice must be received from a UK registered advisor before any transfer can take place. UK advice is also required for transfers from defined contribution schemes which have safeguarded benefits such as guaranteed annuity rates. Comparison of transferring to a New Zealand ROPS against transferring to an Australian self-managed super fund ROPS scheme. There are no age restrictions on transferring to New Zealand, but to be eligible to transfer to an Australian ROPS self-managed super fund, all members must be aged 55 and over. There are no contribution caps if you transfer to New Zealand. Within Australian, there are contribution caps that apply to any transfer. There are substantial tax benefits to be gained. If you transfer to Australia, there is tax payable on any growth of the fund from the date of residency to the date of transfer. You can elect to hold the funds in any currency. There could be additional costs involved with annual self-managed super fund tax returns required. Transfer to New Zealand and 30% tax-free withdrawal from the age 55. There is no withdrawal of any funds allowed until Australian conditions of release are met. You can draw a tax-free pension annuity from age 55. What would happen if I left my funds in the UK against transferring? Any income from the UK is determined by annuity rates or actuarial figures. If I transfer my funds, they are invested within a managed portfolio. Any UK income drawn is subject to income tax at your marginal rates. Income received in New Zealand is tax-free at age 55 and tax-free after age 60 in Australia if conditions of release are met. UK income received is subject to exchange rate fluctuations. By transferring these funds, you can eliminate any currency risks. Upon death, if your fund is left in the UK, your dependents may only receive a proportion of the pension. If transferred, the dependents will be entitled to the 100% of the entire fund upon death. New Zealand iSelect ROPS scheme is registered with HM Revenue and Customs. An investment is actually open to non-residents of the scheme, such as foreign investors who want to transfer their UK pension schemes. It's one of the most flexible on the market with competitive charging structures. I've got a client age 58 with 200,000. If he transfers direct to his Australian self-managed super fund, there will be tax payable on the growth of the fund from the date of residency to the date of transfer. If the client was to transfer direct to his New Zealand iSelect, immediately be a 30% tax-free withdrawal, and the remainder can be held in pounds sterling until a more favourable exchange rate occurs. He can then withdraw a tax-free income stream, which will be adjusted annually to provide a pension for life. For an example here of the New Zealand iSelect investments and using a balanced model portfolio, you can see what the money is actually invested within. There are a lot of considerations that need to be made before transferring your funds. You need to understand what benefits are actually being given up in the UK. What happens if the benefits remain in the UK? Death benefits. My spouse may only receive 50% of the annual pension and nothing passes to any dependents. Will the pension die with me? Can I protect my estate, ensuring that the funds are passed in accordance with my wishes? Consider exchange rates and foreign income tax. The annuity is taxable at your marginal rate should it be retained in the UK. You need to ensure there is sufficient UK lifetime allowance available before a transfer takes place, and you need to ensure that any Australian contribution caps and UK lifetime allowance limits are not exceeded. UK lifetime allowance is the maximum value of pension benefits that can actually be crystallised without a tax charge being applied. A recognised transfer to a ROP scheme is classed as a benefit crystallisation event, a BCE. Each BCE can trigger a lifetime allowance test. Any BCEs in excess of the lifetime allowance test will actually incur a tax charge of up to 25%. The current UK lifetime allowance is 1 million. You usually have the option to pay tax if your pension pots are worth more than the UK allowance. This would therefore protect your pension pot from any reductions to the lifetime allowance. If you wish to return to the UK and you've already transferred your pension out of the UK, the UK pension scheme will not accept a transfer back in from an overseas scheme. Your pension must remain in Australia or New Zealand and can be drawn down when eligible, but then you'll be subject to exchange rate fluctuations and tax. Temporary visa holders living outside the UK should carefully consider the consequences before transferring. What if you don't obtain residency? Then the transfer will have to return to the UK, but there is nowhere for it to return to. It cannot remain in Australia. Contribution caps are applicable to transfers to Australia only. There are no contribution caps applied if you transfer to New Zealand. All UK pension transfers are classed as non-concessional contributions. The current non-concessional cap is $180,000 per tax year, and it applies to all overseas transfers to Australia. Using the 3-year brought forward rule, you can transfer up to $540,000, then nothing more for 3 years. Any funds in excess of the $540,000 will require a UK holding fund for the funds to be transferred to and then transferred to Australia within the caps permitted. If the cap is exceeded, then there will be an additional tax of up to 46.5% will apply to the excess amount, and also an unauthorised tax charge will be applied to the fund. The NCC caps will be changing in July this year to $100,000, using the brought forward rule of $300,000 per year. One of the main benefits of transferring to New Zealand is there is no contribution cap. If you transfer your funds to Australia, then it's going to be tax payable on the growth component. This is the increase in the value from the date of residency to the date the lump sum actually arrives in Australia. This will be taxable at 15%. May be beneficial for clients with little or no income to actually submit this applicable fund earnings on their income tax return and pay tax at their marginal rates. There will be an exemption for any transfers that happen within the first 6 months of residency or if a foreign employment has ceased within the last 6 months. There are substantial tax benefits on transferring to New Zealand. PTS offer a free UK pension tracing service. There is no obligation to proceed with the transfer once the transfer value is obtained. You cannot make a decision to transfer until you have all the facts and figures. We will also find out your retirement projection and any death benefits. We can assist with the UK advice and report if required. A statement of advice is prepared and presented before any transfer is initiated. The transfer process can take between 3 to 6 months. A lot of key points that need to be remembered before transfer occurs. Any UK transfer is classed as a benefit crystallisation event and will be subject to UK lifetime allowance tests. Any benefits that are transferred in excess of this lifetime allowance will be subject to tax penalties. You need to consider your retirement age. You must allow for the 10 years UK reporting requirements before Australian superannuation rules apply. You've got to consider any funds are in excess of the $540,000. They may require multiple transfers. This office is changing in July 2017 to be $100,000 per year and a $300,000 brought forward rule. What would happen if the fund's value exceeded this amount? Any fund growth is taxable in a transfer to Australia, but this is not applicable if the funds are transferred to New Zealand. UK pension transfers are very complex and time-consuming. Most defined benefit final salary transfers are only guaranteed for 3 months from date of calculation, and there is a charge of up to £400 to obtain a revised transfer value. There are considerable tax benefits to be gained by making the transfer. You need to consider the non-concessional and concessional tax caps before transferring to eliminate any unauthorised tax charges. You need to consider exchange rate fluctuations. If transferring to New Zealand, you can elect to hold the funds in any currency you wish until a more favourable exchange rate is obtained. You must consider the 10-year tie-in for CUROPS fund reporting. If you have any questions, please call PTS team on 08 9233 9269 or email pensions@ptspecialists.com.au. Thank you.